We were hoping for a positive start to the week. Unfortunately, that was not to be. The Indian markets opened on a downward spiral. The Nifty ended up losing 311 points. The Sensex, more than 950 points. A lot of airy words are being thrown around, like Monday mayhem, bloodbath on the Lal Street. But what exactly led to this, and what does it mean for you? Let me explain. Put together, investors lost a lot of money today. Nearly 7 lakh crore rupees. That is $85 billion. And this did not start on Monday. The last working day, Friday, was equally bad. Investors lost nearly $49 billion. So that is 2 really bad days for the Indian markets. The question is, will things get worse? And to answer that, we must look at the factors driving this plunge. The first is the resurgent dollar. Earlier today, the Indian rupee plunged to a record low. It slid past 81.5 against the US dollar. This is the lowest level in the history of the Indian currency. What explains this slide? The economic uncertainty. During such times, investors prefer safety more than anything else. So they look at the dollar. It is considered to be safer than any currency in the world. When more people seek out the dollar, its value also increases. Simple logic. Higher the demand, higher the price. But for other currencies, this means depreciation. Take the British pound, for example. It has fallen to an all-time low against the dollar. The euro is at the lowest in 20 years. The Japanese yen is nearing its 24-year low. What does this mean for the markets? It means investors will not be interested anymore. They will take their money out of these markets and invest in safer avenues abroad. And it's already happening in India. On Friday, foreign institutional investors removed a chunk of their money from the Indian markets. How much money am I talking about? Nearly 2,900 crore rupees. Remember, that's in one day alone. All of these indicators point in one direction, a recession. Experts have already started sounding warnings. We earlier told you what Nouriel Roubini had said. He is a noted economist who had predicted the 2008 recession. He had another prophecy, and I'm afraid it's not good. Roubini says the world could face a long and ugly recession. Other agencies reflect this doomed forecast, like the OECD, the Organization for Economic Cooperation and Development. They have a new report that's out. Let me tell you about the key takeaways. The global economy is expected to grow by 2.2% in 2023. Their first projection was 2.8%. So they have slashed it by 60 points. The Eurozone is expected to be the worst hit. Their GDP growth this year is projected at 3.1%. But next year, it could slow down to 0.3%. And if that happens, Europe could spend some part of 2023 in recession. Within Europe, Germany is the worst affected. Its GDP is expected to contract 0.7% next year. And there is a reason why Europe is expected to face the worst of it. In one word, energy. Their pivot from Russian gas is not going well. European countries have been forced to ration ahead of the winter. They are turning off air conditioners, regulating heaters, even switching off the street lights. Such rationing tactics inevitably slow the economy down. So at this rate, Europe could slip into a recession next year. What about the rest of the world? Well, a recession in Europe will likely be exported elsewhere. Take the US, for instance. Their GDP is expected to grow 1.5% in 2022. But next year, it is expected to slow to 0.5%. So maybe not a recession, but a lot of economic pain. And that pain will be felt all over the world, including in India. If the West slips into a recession, people in India will also feel the pinch. Fewer investments, fewer jobs, fewer exports. America is one of the biggest merchandise markets for India. Last year, their market share was 18.1%. If the US slips into a recession, that market will shrink. And experts say software could be the worst hit. So the bottom line is this: there will be a painful economic slowdown. The only concern is, will that snowball into a recession? A lot depends on what happens in the next few months. Will the US Federal Reserve announce more aggressive rate hikes? If yes, then a recession is more likely. Will the war in Ukraine drag on or intensify? If it does, supply chains will continue to suffer. Experts are continuously tracking indicators to predict a recession, and one of them being oil prices. If a recession is around the corner, oil prices usually fall. It's simple logic. During recession, economic activity falls, whether it's air travel, factory work, or industrial output, which means the demand for oil is low. So what are the oil prices looking like today? Again, not good news there. They plunged for a second straight day. Brent crude slipped 1.2%, and the West Texas Intermediate dropped 1.1%. Both of them are key global benchmarks of oil prices, and both of them are hinting at a recession. So how must you prepare for this? I know the economic jargon can sound scary, but recessions are part of any economic cycle. Planning and resilience will be key to overcoming them. So if you are worried about the looming crisis, keep these things in mind. First of all, prioritize safety nets like health and life insurance or education budgets for your children. They must be on the top of your to-do list. What about investments? If you are looking at equity, blue chip stocks are the way to go. Yes, they will also feel the pinch, but in the long run, they are safe bets. And experts also suggest investing in physical or alternate asset classes, for example, gold. And finally, your spending pattern. I'm afraid the era of cheap credit is coming to an end. Central banks are trying to curb spending with interest hikes. It's good to take a cue from them. Now may not be the time for splurging. So keep these tips in mind, and above all, stay on top of things. Make sure you are planning your finances more carefully this year. WION now available in your country. Download the app now. Get all the news on the move.